Hello, hello. Happy Wednesday to you. I am Nathan Garcia, and I want to give you a quick recap of the market performance here because we had a really rough day in the stock market, and a lot of people are probably looking at the performance and looking at their portfolio, seeing red like you have behind me here and saying, oh my gosh, is the market broken? What's going on? What do I need to do? And you probably have some questions. So I want to bring you a little bit of insight from my vantage point, show you what I'm looking at, how I'm interpreting this, and also be a resource for you going forward, so that you can get your questions answered. So behind me, you see a map of the S&P 500. This is from the Finviz, Finviz.com. And what you're looking at is just a sea of red. You see major names like Apple down 4.63%, Amazon down 6%, Microsoft down 5.43%. You had the Nasdaq down about 4% today. Dow Jones fell about 800 points. So we've had a big day here in the market, and a lot of this has people questioning, where are we going from here? What's the cause, and what should I do? So let me just start off by looking, by giving you just a general take on things, and that anytime that you are trying to time the market, you're not in your best position, because the reality is that you probably don't have the insight and the speed to take advantage of changes like this. And so if you are looking to get out of the market, the question is, when do you get back in? Because if you don't stay in the market, what will happen is that you will miss out on some of the major gains that will come when we start to see a correction. And I think that what we're looking at right now is bigger than a correction. You've got some bigger name stocks that are down a significant amount, and some of them are going into bear territory. But at the same time, that doesn't mean that you should try and time the market and figure out what the best opportunity is for you, because in retirement, you're really looking at staying invested over the long term. Hopefully you're planning on a 20 and 30 year retirement. And if you're looking at just today, this week, this month, this quarter, then you really are missing the forest from the trees. And so the first thing that I would advise you before you consider taking money out of the market is to consider your overall risk tolerance in your portfolio, and make sure that that's in line with what your return needs are for retirement, so that you can have a successful financial plan, a successful Monte Carlo, and have peace of mind that when days like today happen, you're not fretting looking at, oh my gosh, I need to sell and go to cash, or oh my gosh, my portfolio is down 5%. What do I do? Okay. If you're in that type of situation, it's time to really get into a financial plan, to start looking at your investment risk and make sure that it's in line with your overall retirement needs, okay? Because when you're in a financial plan, what can happen is that you should be building a portfolio that's based on your personal risk tolerance. All right. The S&P 500 is not your risk tolerance. The Nasdaq is not your risk tolerance, unless you're just already, you've accumulated enough money where you don't really care if you're down 20, 30% over a certain period of time. But for most people, they're not in that situation. And so their risk tolerance is really what is going to dictate if they're going to have peace of mind when we have days like today. And so if you don't have a risk-based portfolio that's aligned with your financial plan, get that as soon as possible, because what we saw is a pretty significant breaking of longer-term trend lines. When we look at the market in general, from my standpoint, I'm always looking at longer-term trends. We use the moving averages, the 55-day moving average, the 210-day moving average, the 110-day moving average. And the reason being is that over that period of time, what we're really looking at is about 6 weeks, 12 weeks, and about 20 weeks of market performance there. And when we look at the performance over longer periods like that, we can get a better understanding of, on a longer term basis, are changes happening, and is it likely that we are pivoting? And the catalyst for all of this has really been the change in interest rates that we saw from the Federal Reserve last week, where they came out and said that they were raising rates and they expect to continue raising rates going forward. You also had Chairman Powell come out and say that he thinks that equities were overvalued and that they're in dangerous territory. And then along with that, you've seen on Sunday night, the Chinese market opened back up. You saw that drop about 4%. We didn't really feel that on Monday in the U.S. here. But then as people are looking at the rising interest rates, they really have to take a step back and say, should I have this money in the market where I'm going to be subject to the volatility risk and the performance risk, or should I just go into something that's going to give me peace of mind and a decent return now that I can get a 10-year U.S. bond that's trading around 3%? So I think that that's really the catalyst that sparked this, is that the rise in interest rates, some of the commentary that's come out from the Fed, some of what's going on internationally with China and the trade fears, but also you've heard the IMF came out, they cut their global growth forecast, and people are looking at this in a period where we're in the fourth quarter. So a lot of portfolio managers are going to adjust their portfolios to make sure that they're rebalanced and they have the right risk exposure. But then also we're at a phase where interest rates have increased and now they're above the dividend yield that you can get in the S&P 500. And so now investors have to make a decision. Should I keep a certain percentage of money in the market where I'm going to get a dividend yield that's less than what I can get on a guaranteed basis from bonds? And so I think that all in conjunction is really what's causing this right now. And it's really an interesting period of time. Now, we have to remember that the Federal Reserve in the U.S., the European Central Bank, the Bank of Japan, the Bank of England, all of these central banks have, on a coordinated effort, suppressed interest rates globally. As a result of that, investors have been a lot more comfortable taking risk. Now, as they are raising interest rates, they are making investors choose between having that money in the market or going to a guaranteed bond itself. And as the interest rates increase, it's going to increase borrowing costs. And so you may have had people who are borrowing money from Japan at 0%, and then they're putting it in the U.S. stock market where they're getting a guaranteed 2.25% return on the dividend yield, and they're making a good amount of money off that. Well, now as interest rates begin to increase, that may no longer be an option for these guys, and so it's causing investors to change their risk exposure and to reevaluate where they have their money. So the involvement of the central banks in the markets has definitely had a big impact on how complacent investors have been, because as long as the central banks are out there saying, we've got the markets back, don't worry about it, anytime the market comes down, we're going to be there to lower interest rates or to start buying bonds like they're doing in Europe. Things like that give investors peace of mind that they can have the foot on the gas and exposure to equities for as long as they want without really worrying about the downside risk, because they know anytime that the market gets in trouble, we're going to have the central banks come out and they're going to come up with quantitative easing or some bond buyback program or something like that. Now the tone is changing from these central banks, and it's causing people and investors to reevaluate those positions. The other thing that has come as a result of this is that a lot of people have put their money into exchange traded funds over the past 8 years. The value of money that's invested in exchange traded funds relative to mutual funds has grown significantly. And I bring that up because that has that's a big factor to do with the liquidity in the market itself, because the exchange traded funds are going to trade based on the underlying stocks themselves. And that's going to have often what you see is that the fund itself may go down more or less than what the individual stocks do. And so if you have a sell-off, let's say in Apple, you may have a sell-off in the FANG ETF that's greater than the Apple sell-off. And it's this whole cycle that one domino knocks down the next, knocks down the next, knocks down the next. So that in itself is going to have a big impact. And then, of course, you also have the high frequency trading funds that are involved in the markets. They've taken positions on derivatives, right? So I'm getting a little bit more advanced here, but I want to give you the full picture. And so those derivatives are also going to have a big impact on any time that we see a sell-off. So today, you maybe the neutral place where we saw the sell-off was about 2%. But because of some of the underlying market factors, that may have been exacerbated and dropped down to 4%. I'm not saying that's the case. I'm just telling you that when you have when you have $1 quadrillion of derivatives that are in the market that are tied to these equities, and then they're packaged into ETFs, and then you have these high frequency traders and the CTAs trading this, that's going to have a big impact on the market. And this is what I've been saying. If you've been watching me for at least the past 2 years, I've been mentioning this over and over and over again, is that you have to have a risk-based portfolio that's appropriate with your financial plan so that you're able to have peace of mind during periods like this. Let me just make a note here of what we've seen. I told you that some of the long-term trends on a technical side are starting to shift. So we look at the Dow. The Dow's below the 50-day moving average. We see the S&P 500 is below the 100-day moving average. You've got the Nasdaq below the 200-day moving average. Small caps below the 200-day moving average. Transportation down below the 200-day moving average. So when we look at things on a longer-term basis, we're noticing that these trends are shifting. These longer-term trends have shifted. Okay. And what we're also seeing is that the leaders in the market, Microsoft, Amazon, those two stocks themselves have made up about 70% of the returns in the S&P 500 year to date. So when you see the leaders in the market start to sell off, Microsoft down 5.4% today, Amazon down 6% today, that's a signal that maybe we're starting to go into a different direction here. So, I wouldn't be too concerned about this if you are well diversified, if you have a risk-based portfolio that's in line with your financial plan. I wouldn't be concerned at all about it. I think that this is healthy to a large degree because trees don't grow to the sky. We also have to consider that, you know, if the market needs some sort of pullback occasionally in order to catch its breath and in order to bring new money in, because the valuations of these stocks right now are really, really, really expensive. And so when you start to see a sell-off like this, it's good. Now remember, in September and August, you had insiders, the CEOs and the people on the chair, on the board, they were selling at record paces, right? The biggest pace since 2007. So am I surprised to see this? Not at all. Right? Because the smart money, the guys who are holding millions and millions of dollars of their company stock, they were selling off in August. They were selling off in September. Okay, so what we're seeing now, I believe, is just a reaction to the interest rates being raised last week, and also to what we see coming out of China. And I wouldn't be surprised to see a bounce back here towards the end of the week. I'm really curious as to what goes on tonight when the Chinese market opens, because you have such a globally interconnected economy and markets. I think that anything that happens here is going to carry over into China, and that could carry over tomorrow in the U.S. markets when the markets open here at 9:30 in Eastern time. So we will wait and see. Again, I look at the valuations of the stocks, of the markets themselves. I personally think they're high. I'm not speaking for my company. I personally think that they're high. I think that this is good to see a sell-off in this manner. I don't know how far this will continue to go, but I don't think that we're necessarily in a 1987 type of moment, you know, when October 1987, where you saw the market drop 20% overnight. I don't think that we're there. But it'll be interesting to look at this and to pay attention. So what should you do at this point? Well, the big thing is you have to look at your risk tolerance in your portfolio. You also have to consider your exposure to alternate asset classes. So if you're just holding stocks and bonds, whether they be in individual stocks and individual bonds or in ETF form, you really have to consider diversifying out of those asset classes and into alternative asset classes that are not going to be so correlated with the market. Again, because of the involvement with central banks, you've seen the correlation between stocks and bonds increase. And so even in days like today where you had the Nasdaq down 4%, you've seen that the TLT, 30-year bond fund, it was still down. It wasn't down as much, but it was still down 30 basis points, right? So the traditional ideology here with portfolio management is that if stocks go down, bonds go up. That's not happening anymore. And the reason is because you're starting to see that the packaging of the ETFs, the CTAs, the high frequency trading, the involvement with central banks, all that is starting to come to a head. And so if you need to take distributions from your portfolio in order to fund your life in your retirement over the next couple of years, you really want to be cautious of your investment allocation, and you want to be aware of alternative investments, alternative asset classes that are not going to be as highly correlated to the market. So I hope that you have a little bit better insight than when you started watching this video. I wouldn't let the hysteria of the media get to you. Again, if you're holding your portfolio as a long-term investor for 30, 35 years in retirement, I'm not as concerned about something like this. I don't know if it's necessarily a buying opportunity yet, but it's something that I think is healthy and I think that is long overdue. So let me know what questions that you have. Thank you for tuning in. If you found this video helpful, please share it with a friend, and I look forward to seeing you in my next video. Take care.